Hey everyone, welcome back to Corporate Decoder, the place where we uncover the surprising truths hidden in plain sight in company filings. Today we're diving into Amer Sports' latest report, which might just have some interesting revelations about their financial health given the period they're covering. Get ready folks, because we're about to break down Amer Sports Inc.'s latest filing with the SEC. This report is all about their performance for the 3 and 6 months that ended on June 30th, 2025. Think of it as a mid-year checkup for a company that makes sports equipment and apparel, so let's see how they're doing on the field and off it. So what's the big news here? Well, on August 20th, 2025, Amer Sports dropped their latest financial statements. These are the unaudited numbers for the first half of the year, ending June 30th, 2025. Essentially, we're getting a glimpse into their performance so far, and it's important to remember these are interim statements, meaning they're not the final word for the whole year, but they give us a really good snapshot. Now, the real meat and potatoes of these filings are usually in the management discussion and analysis part. This is where the company's leaders explain what happened during the period, why it happened, and what they expect in the future. It's like getting the inside scoop directly from the horse's mouth. They'll talk about sales performance, any major business events, and what's driving their financial results. Then we get to the financial statements themselves. These are the numbers, the hard facts that back up management's story. We'll be looking at things like revenue, profit, and any changes in their assets and liabilities. This is where we can really see if the company is growing, making money, and managing its resources well. Let's get into the numbers, because that's what we all love to see. The company is reporting in US dollars, which is pretty standard for many international companies. This number, 0.000198888894, this is their unique identifier within the SEC system. Think of it as their social security number for the stock market. We're looking at data points as of June 30, 25. Amer Sports is broken down into different business segments, and technical apparel is one of them. They also have an outdoor performance segment and a ball racket sports segment. These are the core areas where they operate. Management is reporting on their operating segments to show performance across these different business lines. This helps investors understand where the company is making its money. They also talk about material reconciling items. This is typically stuff that doesn't fit neatly into one segment, but is important for the overall financial picture. And unallocated amounts, those are general corporate expenses that aren't tied to a specific business segment. Geographically, they report on the Americas region and the EV region, which stands for Europe, Middle East, and Africa, Scrolfart, Asia Pacific member states, and finally Asia Pacific. This gives us a view of their global reach. The company is also reporting specific country data for the US. Within their segments, they also break down performance by channel like wholesale and direct to consumer or DTC, which is a growing area for many companies. Looking at equity details, they mention their employee stock ownership plans from 2019 and 2023. This relates to how they incentivize their employees. They also discuss restricted share units, which are another form of employee equity awards, and performance share units, which are similar but tied to company performance. Let's look at their assets, specifically property, plant, and equipment. They report on land, machinery and equipment, and construction in progress. This tells us about their ongoing investments in physical assets. They report the gross carrying amount, which is the original cost of these assets before any depreciation. And the accumulated depreciation and impairment, basically what value has been used up or lost over time. They also detail accumulated impairment, which measures any permanent reductions in an asset's value. Now for liabilities, we see they have a warranty provision. This is money set aside for potential product repairs or replacements. They also have a restructuring provision, likely for costs associated with reorganizing the business, and miscellaneous other provisions, which covers a range of other potential liabilities. They issued new senior secured notes worth $800 million, maturing on February 16th, 2024. This is a significant debt issuance. They also have a line of credit with China Merchants Bank. These credit lines are important for their operational flexibility and an IFRS revolving credit facility, showing they have access to more borrowing. When it comes to financial assets, they categorize them. Assets at amortized cost are typically loans or receivables that they expect to be paid back with interest over time. They also have assets at fair value through other comprehensive income. This means their value can fluctuate with market conditions, but these fluctuations don't immediately hit their profit and loss yet. And assets at fair value through profit or loss. Changes in these assets directly impact their reported earnings. The valuation of these assets is often done using fair value hierarchy levels. Level 1 is based on quoted prices in active markets for identical assets. Level 2 is based on observable inputs other than level 1 prices like interest rates or yield curves. And level 3 uses unobservable inputs, meaning they have to make more assumptions and estimates to value the asset. This can mean more uncertainty. On the liability side, they have financial liabilities at amortized cost. This typically includes things like loans and bonds where the value is the principal amount plus accrued interest. This includes long-term borrowings, which are debts due in more than a year. They also have long-term obligations under leases, which are commitments to pay for the use of assets like buildings or equipment over extended periods. They also have liabilities measured at fair value through other comprehensive income. These are less common for liabilities, but can occur with certain financial instruments. And short-term borrowings, which are debts due within a year. Current accounts payable are amounts owed to suppliers for goods or services received. Current accrued liabilities are expenses that have been incurred but not yet paid. They also report on derivative financial instruments. These are contracts whose value is derived from an underlying asset like currencies or interest rates and are often used for hedging risks. Promissory notes are also listed. These are written promises made by one party to pay a specific sum of money to another party. Looking at equity compensation, they talk about vested and unvested shares of restricted share units, performance share units, and stock options. This is a key part of how they attract and retain talent. They specifically call out unvested performance share units and stock options, which are still pending for employees. There's mention of major purchases of assets on July 22nd, 2025. This indicates significant investment in growing their business and entering into significant commitments or contingent liabilities, which are potential obligations that depend on future events. This includes bonds and guarantees related to China Merchants Bank. This shows they are actively managing their financial relationships and obligations. Alfred, this filing is a Form 6K, which is a report of foreign private issuers. It means Amer Sports is a foreign company reporting its financial information to US regulators. Their commission file number is a bit of a mouthful, 001-41943, but it's unique code that the SEC uses to track them. They've indicated they file under Form 20F, which means they are a foreign private issuer and thus rely on that form for their annual reports. Looking at the breakdown of their segments, technical apparel, outdoor performance, and ball racket sports, it seems they're playing in multiple sports arenas. The fact that they are detailing their performance by wholesale versus direct-to-consumer channels is a smart move. It shows they're paying attention to how they reach their customers, and that DTC growth is likely a big focus. Companies that can effectively leverage both strategies often have a more robust business model. The geographical breakdown into Americas, Greater China and Asia Pacific highlights their global footprint. China, for instance, is a huge market, and their specific reporting there suggests its importance. We'd want to see strong growth in these key regions to understand their overall success. Now, about those financial assets and liabilities, the levels of fair value hierarchy are particularly interesting. When companies hold assets or liabilities valued at level 3, meaning using their own unobservable inputs, it can signal a higher degree of estimation and potentially less transparency than level 1 or 2 assets. It doesn't automatically mean something is wrong, but it's a flag to watch closely. If a significant portion of their portfolio is level 3, it could mean more volatility and less predictable performance. Their debt structure also warrants attention. They've issued senior secured notes and have revolving credit facilities. This is common for large companies needing capital, but it's crucial to see how this debt aligns with their cash flow generation. Are they earning more on their investments than they're paying in interest on their borrowings? That's the key question. The provisions for warranties, restructuring, and miscellaneous liabilities all point to potential upcoming costs. While these are normal accounting practices, it's important to monitor if these provisions are adequate. For instance, if their warranty provisions consistently fall short, it could signal product quality issues or aggressive accounting. The different types of equity awards for their employees, like restricted share units and performance share units, are standard practice. What matters is how these awards are structured and whether they truly align employee interests with shareholder value. Time will tell if these programs are effective in driving long-term growth. When we look at their property, plant and equipment, the distinction between gross carrying amount and accumulated depreciation and impairment is vital. A high accumulated depreciation on still valuable assets might mean they are keeping assets longer, or a low accumulated depreciation could mean assets are being replaced frequently. Also watch out for accumulated impairment. That's a direct hit to their asset values. Overall, Amer Sports seems to be operating across diverse product categories and geographies, which can be a strength by spreading risk. However, it can also be a challenge to manage such a diverse portfolio effectively. The move towards DTC is a positive indicator of adapting to market trends. The fair value hierarchy levels, particularly level 3, are areas we want to dig deeper into to understand the potential risks associated with valuations. Their debt levels and provisions are normal for a company of this size, but will require ongoing scrutiny to ensure they are manageable against revenues and profits. What's your take on Amer Sports' latest report and what these financial details might mean for their future performance? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more in-depth corporate analysis. Don't forget to join our Discord community for more discussions and insights linked in the description. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.